welcome to Outlook Money's Investment Made Easy webinar series. This episode is spearheaded by ICICI Prudential Asset Management Company Limited as part of the Investment Awareness Initiative of ICICI Prudential AMC. I'm Versha Jain from Outlook Money. Welcome to another episode in our series. Strong financials, stability, and steady profits are the key traits of quality factor in investment. Quality is defined as an identification criterion. Under this factor, stocks are filtered based on parameters like strong financials, steady earnings, and low debt levels. These parameters help find stocks that can withstand market fluctuations and remain stable during market downfall. Stocks, mutual fund, or exchange-traded fund (ETFs) filtered based on quality factors are considered to perform better during a market downtrend. While the last couple of months have been volatile since the budget this year, the market has been on a downtrend. The recent turnaround since mid of March, also seems to be a temporary relief. However, experts advise against panicking and recommend staying invested for the long term. While it is difficult for anyone to predict the market, an investor should know how to effectively handle market downfall, volatility, and other market scenarios instead of reacting to it. Today, we'll uncover how they work and whether quality ETFs fit in your investment strategy. To discuss this in details, today we have with us Mr. Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC, and Ritu Poddar, Head Research and Product, Third-Party Product, Nirmal Bang. Welcome, Mr. Haria and Ms. Poddar.
Hi, Versha.
So, Ritu, my first question is from you. I want the answer from you. To start with, please explain what are quality ETFs and their difference from other ETFs.
Varsha, as you correctly mentioned, that factor-based investing in is becoming popular in India, and we have seen that it gives you a benefit of both active and passive investing, and makes selection more systematic. And that is the reason we have seen that last year the AUM of this particular category actually got doubled. And as you said, that what is quality as a factor, and you mentioned few parameters. So quality investing is a investment strategy which focuses on investing in a high quality companies with a strong fundamentals. So these companies are typically well established, having a track record of consistent earning growth, and have a strong balance sheet. The idea behind quality investing is that these companies are more likely to weather economic downturns and market volatility, which can result in more stable returns or better risk-adjusted return, I would say, in over the long term. How it's different from plain vanilla ETFs? So it's like, the cricket season is going on, so I would like to give an analogy. So if you would like to pick two cricket teams, one for IPL and another for World Cup. So IPL teams are like, a plain vanilla ETFs, a mix of star players, the young talents are there, and some out of the form players also, are part of a team. Just like, any broader indices or plain vanilla indices, we take it. There, you will find a strong as well as the weak companies without any filter. At the same time, if you are going to choose a team, the team is going to play World Cup, there will be, hand-picked players, the players who are consistent in their games make a squad. So similarly, quality ETFs select financially strong and high-performing stocks for long-term success.
All right, wonderful analogy you have used. Now, Chintan, I have the next question from you. As we have already discussed the quality funds earlier. Now, please explain how quality funds differ from quality ETFs and what factors define a high quality ETF.
So I think if you look at the basic difference between a fund and an ETF, if you're referring to an index fund, essentially, it's basically similar to a mutual fund. So the same logic applies here as well. A quality ETF is something which is traded on the exchange. Underlying stocks remain mirroring to the quality ETF or the quality index. And as far as the quality index funds or the fund is concerned, it's essentially a fund which basically is investing in quality stocks. Now, as far as fund is concerned, it can be active and passive both, right? So while we are only speaking about passive funds, there can be potentially quality based selection on the active side as well. So there can be an active quality fund and a passive quality index fund as well. And as was mentioned by Ritu, there is a very high long-term track record which can be seen in terms of the index performance, and that shows that quality as a factor should be a part of most investors' portfolio, because quality as defined, and you also beautifully explained it earlier, is all about fundamental factors like ROE, like debt to equity, and you know in terms of low leverage, the debt to equity, and consistent earnings. So these three things ensure that high ROE means return on equity means that this company can grow faster and can reinvest its capital. So the growth is there. Low debt to equity means the bankruptcy risk comes down meaningfully. And if you look at the third parameter, it ensures that there is consistent earnings. So it's not like a one time there is some earnings bump which comes specifically say in metal companies etc., where the earning bumps come and the company starts looking cheap. It is consistent over last 5 years. That's was essentially how the filtration happens. So that's what makes quality as a factor not too cyclical and long term oriented. And the good part is when we are speaking right now, quality as a factor for the last 4 years has underperformed the momentum and the alpha factor. So the price based factors like momentum and alpha have done well, while the fundamental factors like quality and low vol have not done so well. So value and momentum have done well in the last 3 4 years, while low vol and quality haven't. And so quality becomes a good investment for investors if they're looking at increasing their equity levels right now, especially when there's volatility in the market.
Right. So quality factor is not cyclical. My next question is from you, Ritu. How does the quality factor differ from value or alpha or momentum factors of investing?
So as we mentioned earlier, the selection parameters are different of each and every factors. Like we talked about, quality factor, which focuses more on the financial strength, select companies with a high profitability, low debt, and the stable earnings kind of stocks. At the same time, if we pick up, a low volatility, it selects stocks with a stable price movements, but less focus on the fundamentals. At the same time, value, which invests in undervalued stocks without prioritizing the financial health of the stock. Growth, definitely, high growth, high earning revenue growth companies, but regardless of the stability. Momentum, if we'll talk about, then it's a recent price trend, what is going on, and that comes the universe without, considering business fundamentals. So these are the, basic parameters basis on this, the universe actually being created. But in short, quality is a factor which emphasizing financial health, while other factors actually rely more on market trends, valuations, or volatility. So every factor has a different parameters to select and basis on they invest.
Thank you for explaining it so nicely. Now, Chintan, what are the benefits of investing in quality ETFs, and are these better than value and volatility factors during market downturns?
So as we've always been mentioning, all the factors have their specific criteria, and those factors work in different market conditions. Quality as a factor, of course, over the long run works better because the stock selection is such that the stocks have a very high long-term orientation in terms of their growth. But even quality goes through its ups and downs, even like we've seen value go through its ups and downs. So if we break it up between 2015 to 2020, quality as a factor did very well. 2021 onwards, while quality did well, but value and momentum, which weren't doing that well, did much better than quality between 2021 and 2024. And now we would believe that the volatility and the overvaluation plus the momentum and value doing so well means that quality again as a factor will probably start doing better relative to the other factors. So, I mean, as an investor, of course, what you need to see is on an overall portfolio mix, what are the kind of funds that you have, And if you want long-term orientation in terms of your portfolio with stable, steady companies with uh, good debt to equity levels, high growth in earnings, or at least steady growth in earnings, then these companies become a good choice for you. And hence, quality as a factor should be a steady allocation for the long term. You don't need to move around with that allocation. It can be a core strategy in your portfolio, while momentum or value can be a portfolio choice that you can make, or you can time it better. Quality as a part of your core portfolio can be a long-term oriented part of your portfolio is what we believe in.
All right, so quality should be the core strategy in the portfolio. Um, Thank you for explaining it in this way. Now, Ritu, according to you, what are the risks involved with investing in quality ETFs?
Quality ETFs, if you are investing, definitely one is a very common risk, which is a market risk. So if the market falls, even the best stocks in the ETF can drop. So that is the very common risk. And second is a high valuation, as the quality stocks are often expensive. So which can, limit of future returns, in the markets sometimes in a different cycles. So that is another risk, I would say. Sector concentration, uh, not, if you are taking a underlying universe, wide underlying universe, probably, BSE 500, and then you are selecting 50 quality stocks, then probably it might not be sector tilted. But if you are taking a small universe, then, we might see some kind of a sector concentration also. uh, the next is important is interest rate risk impact. Very normally we have seen in a rising interest rate scenario, quality stocks, are less attractive. So in that scenario, might be this quality ETFs might not perform. So every as I said, that every factor has a cycle and every factor has a different parameter to select. So probably in a rising interest rate scenario, these quality ETFs might not perform or give a good returns. And definitely, and the last one is a factor rotation risk. So every factor has a cycle and they keeps rotating, and different market scenario, the performance of the different factors are pretty different, which can, probably we can see some kind of low returns in that kind of a scenario.
All right. Chintan, does every ETF provider define quality in the same way, or there could be differences as well?
So as far as Indian market is concerned, and even globally, if you look at it, quality is a standardized parameter. Much like how Ritu mentioned, the universe and the number of stocks that you choose, that can be different. So out of 500, you can choose 50 stocks. Out of 200, you can choose maybe 50, or out of 100, you can choose 30. So the universe and the number of stocks which are selected can be different for different products that you create. But the core quality parameters or characteristics do not necessarily change because they are global parameters. So much like how, say, for example, momentum is a standardized parameter globally generally, where you say 6-month and 12-month returns, basis that the stocks are selected. Similarly, as far as quality is concerned, the general definition or the trend is to select stocks with high ROE, low debt to equity, and stable earnings. There can be a few other tweaks which are possible, but generally, more often than not, quality has a focus on return on capital employed or return on equity, and that's the core. And the other two parameters are normally associated or partnered with it. So if you look at it, the return on capital employed or the return on equity is a core function of quality. Along with that, you'll have stable earnings and low debt to equity, which is joined together. So while the definitions can be different across the world, but at least as far as India is concerned, the steady definition is there, and only the universe and the number of stocks can keep changing. So investors can be rest assured that when we are talking of quality, the quality parameters would include a focus on return on capital employed or return on equity, along with debt to equity and earnings as a combination.
Okay, so in India, it is more or less the same. Ritu, should investors invest in the factor-based funds, keeping in mind the market cycles, as you have mentioned that every factor has a cycle, or is an SIP approach more beneficial in case of quality factor?
Definitely, it's an open market. So investing in factor-based funds can be approached in two ways. As first one is a tactical allocation based on market cycles, as you said, and second one is a SIP for a long-term averaging point of view. So both the approaches have their pros and cons. Um, Definitely for a tactical allocation, if we talk about, then it requires deep research and active management. So many investors, struggle to time entries and exit correctly suboptimal return or to lead to suboptimal returns, basically. So that requires one of the, expertise to enter or to take a tactical allocation. While SIP is a very smooth and or very, easy strategy to invest in factor investing. It smooth out market fluctuations and reduces timing the risk or the timing the market. Since factors go through cycles, and SIP ensure that you accumulate units at different cycles. Through this you can take a benefit of rupee cost averaging. So I would suggest that a long-term SIP approach is in a well-diversified factor-based fund is much more feasible or good option for the client's point of view, which reduce risk and emotional biases while capturing the benefit of different factor performances over the time. So in an investors has expertise, can track economic and market cycles, probably can take a tactical approach, which can work. But I think most of the investors, I would recommend that SIP approach is a more effective, as it reduces, I said, timing risk and the capture market rotations over the long run.
Right. So SIP is anyway is a better approach because it reduces risk and gives you rupee cost averaging. So very aptly said. Chintan, what has been the trend of quality ETFs over the years, and has their demand increased? What do you think?
So if we look at quality as a parameter, much like all the other factors also, there has been a demand. And in the case of India specifically, supply is creating its own demand. So earlier there were no quality ETFs. Way back in 2015 or the first value ETF came into India. Then there was a low wall which came in 2017. Quality was much later. So when quality ETF started to come, there was a demand for quality which has come in. And in the last 2 years, much like all other factors, quality has also seen takers. And I do certainly believe that in the long run, quality as a portfolio, uh, much like I mentioned, will be a core portfolio for investors, because what has happened is 2020 post COVID to 2025 today, people are used to very high returns, and the kind of breadth of market, the momentum, especially in the mid and small cap space, has been such that the return expectation has also gone up, and it's become too easy possibly for people to feel that okay, money can be made. However, when the markets become a bit more stable and when the economy also stabilizes after the significant spurt we saw in 2021 to 2024, and earnings normalize, the real quality as a factor will play out in terms of the core portfolio of investors' long-term wealth creation. So, 2021 to 2024, these 4 years, quality may have not added value to investors in terms of the relative performance, because it has underperformed the momentum and value. But in the long run, let's say 10 years down the line, if we look at it, quality will again stand out, because many of the quality names, much like how Ritu had mentioned, that one of the risk factors is quality stocks tend to become very expensive, because many investors, including foreign investors, tend to buy quality names in a very big way. And that is what exactly had happened in India, where quality from 2008-9, after the global financial crisis, if you look at it, quality like FMCG or IT companies did very well till 2020. And that 10 years made them very expensive. So typically FMCG companies in India used to trade at 10 to 12, maybe 15 times in 2008-9 PE. Now they are 2020, they started trading at 70, 80, 90 times, even more. So that overvaluation had to get corrected. And I think with 5 years of earnings growth and lack of performance in the quality basket, the earnings growth along with the moderation of valuation means that quality as a factor would again become interesting for investors. And like Ritu mentioned, if you average out your investments in quality over the next 2, 3 years, eventually in the next 10 years, it will hold you in good stead in terms of wealth creation. So from an investor standpoint, it is pretty easy today because the valuations are no longer as expensive in the quality basket. The last 4 years' performance is also underperforming, and so it becomes a suitable time for them to start accumulating the quality basket. And as the name suggests, because the stocks are high quality in terms of their existence, in terms of their valuation, in terms of their core characteristics, investors really should not be worried about what happens in the next 6 months, 12 months. Accumulate over the next maybe 12 months, 24 months, 36 months, depending on your overall allocations. And then over the next 10 years, much like how India grows, this should also grow because the sectors which currently are dominating the quality as a basket are FMCG, IT, which typically are high quality, high ROE companies. So they have underperformed, and that can actually help you in the next 10 years if you accumulate it over the next 3 years. So that's the key takeaway, that start accumulating now over the next 2 3 years, and that should hold you good in terms of wealth creation in the quality basket over the next maybe 5 to 10 years.
Chintan has explained everything around quality ETFs, the potential where it can go, and the underperformance in the last 4 years. Ritu, what do you think? Please advise our listeners some tips for selecting good quality ETFs for their portfolio.
We follow one QELP test to select a good ETF. So Q is quality of underlying index. So whether you are taking your underlying is BSE 500 or BSE 100 or BSE mid cap. So it could be anything. So basis on that, first we look at that, and the second one is represent the expense ratio. So it should be low. Definitely, if you are comparing, factors, so you should compare with the factor within the within the category or within the same factor. You cannot compare the factor based ETF with a plain vanilla, because plain vanilla has a much lesser expense rather than the factor. And the next one would be a liquidity, which should be high. And at the same time, AUM also matters when you are or entering in the ETF space or investing in an ETF. And the last is a tracking error. So tracking error should be low. And whatever underlying is there, the basic actually your ETF is track that particular underlying index. So if they are tracking that, the whatever is the tracking error, it should be low, and that will not increase your much gap between the underlying returns and your ETF's return. So you might sometimes there is a little lesser returns you might get because of the expense ratio and the tracking error, which might impact on your returns. So I think the expense and the tracking error are the two key points which investors should look at while investing in ETF.
All right, so expense ratio and tracking error are the two key points investors should consider while investing in any quality ETFs. Now, this is my last question to you, Chintan. The same question, please share a few tips for potential quality ETF investors.
So I think the first thing that investors should look at is where do they stand in terms of their equity allocation. Back in 2020, when the markets fell, the equity allocation became very low, or people were worried. Then, as the market started doing very well, people's equity allocation started to increase meaningfully. Again, now markets have been volatile over the last 3 4 months, so equity allocations people are again really looking at. So, look at your equity allocation. If your equity allocation allows, then you may choose the quality ETF. Within the quality ETF, whether you want to go towards a large cap based quality ETF, which basically selects stocks from the top 100 names, or you want to go more diversified, which selects from 200 or 500 names, that's a choice which you can make along with your advisor. But the fact is that staying away from equity is not necessarily a choice that you will have in the long run for wealth creation. So if your equity allocation based on your risk profile allows, this is a good time to start investing in quality. Spread out your investments like Ritu has mentioned, and you should be able to get the benefit of it, whether to go towards large cap based quality or diversified, let's say 500 based quality portfolio. That is your choice, which you could take based on your risk profile. But do start investing over the next 2 to 3 years. And the corollary to that is that there may be certain segments of your portfolio which may have made a lot of money for you in the last 5 years. It may not be such a bad time to start booking profits there as well, if the valuations there and the momentum there has been very strong. So you have to look at the trade-off between where you stand in terms of your overall portfolio. And if there are certain pockets in the overall portfolio where you made really good money and you think that is expensive, it is a time to shift towards quality is what I would suggest. Thank you.
All right. So while the market has remained volatile for the past few months, quality investment could be a viable approach for weathering market ups and downs, as our experts have shared. By investing in companies with strong financials, investor can mitigate risks linked with market fluctuations. Thank you, Ms. Poddar and Mr. Haria, for joining us today and sharing your valuable insights. I appreciate the clarity and understanding you provided on quality ETFs.
Thanks, Versha. Thank you, everyone.
Thank you, Versha. Thank you so much.
Thank you. And with this, Investment Made Easy webinar comes to an end. Viewers, we trust you found the discussion engaging and enjoyed the session. Please don't forget to like, share, and subscribe to our channel to stay financially informed. We welcome your suggestions, feedback, and questions at letters@outlookmoney.com. We'll be back with our next episode soon. Until then, stay safe and stay informed.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.